Welcome back aboard, everyone. I hope you've managed to have a great lunch break. Get ready as we set off for more exciting ideas at ETFestival. Before we begin, I'd like to draw your attention to the promotions FSM1.com is running. Receive 3,000 rewards points by opening a new FSM1 account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is Take Flight with FSM1. From now till the 31st of May, enjoy 2 free trades on ETFs in the 2021 edition of the ETF Focus List. The ETF Focus List, put together by FSM1.com, offers investors a starting point by identifying the best-in-class ETFs. Check out the new additions to the list. For more details, refer to the promotional article on FSM1.com. From now till December, FSM1.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. The next segment will be the in-flight portion. In-flight will cover strategies that investors can apply when making their investments. Let's get strapped in as we begin. We will be starting with a panel discussion. Are fixed income ETFs your portfolio's life jackets? While air travel has an impressive safety record, safety equipment is never left on the ground. Life jackets are always available and tucked neatly under your seat. Likewise, in our investing, how do we ensure that we are prudently applying the time-tested principles of portfolio management by diversifying across asset classes? Joining us on the panel today are Adrian Tsui, Vice President, Sales and Product Strategy, CSOP Asset Management Limited. Kelvin Neo, ETF Business Development Specialist, Nikko Asset Management Asia Limited. And moderating will be Weiren, CFA, Manager, Stocks and ETF Research, iFAST Singapore.
Good afternoon, everyone, and thank you so much for joining us here at ETFestival. And for today's panel discussion, we're going to focus our attention on fixed income ETFs. And joining me today are 2 very experienced professionals in the ETF industry, Adrian and Kelvin. Thank you so much for joining us on this panel discussion today. Now, when we talk about ETFs, most of us tend to associate ETFs with equity and stocks ETFs. Fixed income ETFs, on the other hand, they tend to be neglected. They tend to be overlooked by most investors in their portfolios. And it's not surprising because fixed income is an asset class. It tends to be a boring asset class. And also in terms of the expected returns, fixed income investors probably won't be able to get as high a return as they would potentially get in the stock market. But despite that, there are still many investment merits associated with fixed income as an investment. So in today's panel discussion, I would like to just start off our discussion today by posting the very first question to Adrian. Adrian, fixed income is a boring asset class, doesn't generate as much returns compared to the stock market, but why should investors still consider an allocation to fixed income inside their portfolios?
Well, thank you, Weiren, for the kind question, right? So the reason why many investors will avoid or neglect fixed income is based on the simple fact that the minimum investment amount is actually 250,000 Sing dollars per trade, and that would actually set up a high bar that many investors will not even consider investing into the asset class. And having said that, they do not want to commit such a huge amount on a single trade. They also have, riding on a misconception that bonds are pretty illiquid and hence volatile. Now, they are missing out some of the benefits of fixed income, right? Fixed income gives constant, steady payouts. We call it coupons, right? And most of the time, distributions are set at every 6 months or semi-annually. So it gives you frequent payout as well. And because of that, investors are missing out on these benefits. Now, and fixed income ETF, which tracks a basket of performance of a bonds issued by various entities. Now, it slices up the investment amounts from $250 to a smaller, affordable size for investors, and that provides many other investors, such as retail investors, men on the streets, to invest into that fixed income as well. And having said that, it's in terms of pricing for fixed income is relatively transparent, because it's traded like a stock on a stock exchange. So it provides again another access for investors to get into the asset class, via an ETF in this sense. Yeah.
Thanks, Adrian. So I guess amongst the many investment merits, I think one of which you have highlighted is actually regular cash flows. I think diversification is probably also another key investment merits for fixed income investments. But for investors who are looking at fixed income and wondering how they should go about constructing a globally diversified fixed income ETFs. Now, most of us, we are probably not familiar with fixed income markets. So for the next question, perhaps I'll get Kelvin to enlighten us. So Kelvin, for investors who are interested to start constructing a globally diversified fixed income portfolio, what do you think are some of the key markets that they should start off with?
Right, so thanks, Weiren, for the question. I think the best way for investors to construct a globally diversified bond portfolio would be really to construct one that mimics the reality. And the reality is that the biggest bond markets in the world today are namely the US, China is number 2, you have Japan number 3, and then some European economies, followed by some economies in Asia. And if you want to build that portfolio that is globally diversified, it should have those countries in there. Right? In terms of the segments that should go into the portfolio, I think one easy way is to look at it from a risk perspective, right? Along the risk spectrum. All investors should definitely start off with having exposure to government bonds. I consider them within the sovereign class, where the risk is very low. And then as you kind of build it up and take on more risk, moving on to, say, quasi-sovereigns, moving on to corporate bonds, which are essentially bonds issued by companies, and then moving on to take even more credit risks, let's say in the space of high-yield bonds, and those are the sub-segments that you can consider when constructing the portfolio.
Thanks, Kelvin. I just have one more follow-up question to what you just said. You mentioned reality. The reality in our current market environment right now is such that fixed income has had a very challenging environment so far in 2021 because of inflation fears. So could you also just share with us, what is your outlook for the fixed income asset class? And do you also think there are still pockets of opportunity within the fixed income space?
Right, so it's a very relevant question. So really the biggest challenge in the marketplace today, in my view, and of course my investment managers as well, is really the risk of rising inflation expectations, which really translates into the possibility of higher interest rates. And that's what really hits the bonds really hard. So, if interest rates rise, bond valuations can come down, and that's really the risk that the market is seeing today. In terms of bright spots, we still see bright spots in the marketplace. I think specifically, in a rising interest rate environment, there are bond investments which gives you lower duration risk, meaning that there are bonds that they are less sensitive, to higher interest rates, so low duration risk. And the good thing here is that generally Asian credit bonds, as well as SGD bonds, meaning Sing dollar bonds, generally they have lesser duration risk compared to, say, government bonds. And this is a segment of the market that we think can be quite interesting for investors to look at.
Thanks, Kelvin. How about you, Adrian?
Yep,
do you also see pockets of opportunities in today's fixed income market?
Certainly. Yep. So I mean, just to echo Nikko's views, that on the flip side, our view is that right now, I think interest rate will stay low in the short term, and given right now in the low interest rate environment, we could, some of the potential areas that go for fixed income that provides better returns than what you're having in the saving banks, or saving returns in saving banks, right? And the key thing is actually without compromising the quality of the investment into the fixed income. And having said that, we should actually look at some of the credit ratings of certain bonds of at least A+. And like echo what Kelvin has mentioned, go for local currencies, Asia bonds such as Sing dollars denominated, and also Chinese government bonds. Yes.
You mentioned Chinese government bonds. I think this is a really interesting topic to talk about because Chinese government bonds, they have been an outlier in the global bond markets today because while the world is selling off, Chinese government bonds, they have been very resilient in terms of their performance in 2021. So perhaps back to Adrian again, could you also share with us what do you think are some of the key reasons that are attributable to the resilience of Chinese government bonds?
Certainly. So, two reasons. One is actually, onshore Chinese government bonds is actually denominated in renminbi. So that is the strength. That's where it's holding up the price in terms of the bonds, right? Due to the effective management by the Chinese government to control the COVID-19 situation in China, and with that, it resulted in a very strong fundamental within the country. So this is one reason. And having said that, that's the reason we could see, April trade balance coming in better than expected. This shows that they are able to, meet the demand. The demand is surge in demand for Chinese goods amid a global pandemic. So that's the first reason. The second reason is actually Chinese government bonds are offering higher yield of about over 3%. Now that is actually very attractive. And having said that, that's very attractive. It provides a price support. When investors who want to buy into access into the Chinese government bonds. So these are two reasons: very strong fundamentals, a strong renminbi, and also very attractive high yields that provide price support for Chinese government bonds.
Thanks for the insights. I think it's very interesting also because Chinese government bonds, they are quite an interesting place to be in at this moment. And as Kelvin has mentioned just now, China is actually the second largest bond market in the world, just behind the US. But the reality in most investors' portfolios is that China is largely underrepresented in most portfolios, despite the bond market being the second largest market in the world. So I'd like to just pose the question perhaps to Kelvin. Kelvin, would you be able to share with us, based on your experience and also your interactions with investors, what do you think are some of the misconceptions or the barriers that prevents investors from wanting to invest in Chinese government bonds?
I think there is, the right word to use here is more of like timing rather than misconception. I don't think investors generally have a misconception about the Chinese market. They're cautious about the market, but definitely very little misconception there. Main thing is timing. Now, why do I say that? The Chinese market has been growing very rapidly over the past 3 decades or so. And they have come a long way. The economy is now probably second largest in the world, likewise for the debt markets. And the market is just starting to open up over the past few years. So what we are really seeing is that we are at an inflection point where China is opening up its debt markets, allowing more foreign investments to enter into the marketplace, and that creates an opportunity for international investors, globally. And really, this is the opportunity for investors to kind of tap on this new marketplace, new investment opportunity, that's kind of how I kind of see this rather than a misconception. It's really more of a timing issue.
What about you, Adrian? What are your observations in this area regarding the adoption of Chinese government bonds in investors' portfolios?
I think for a start, even though we have talked about the benefits of Chinese government bonds, giving up high yields and all, but I think right now it's access into the onshore Chinese bond market. I think recently with the Chinese 14th five-year plan, that's where they're going to open up their markets to foreign investors. I would say that there's still many red tapes, many hoops that even institutions investors have to jump to even get access to the Chinese bond market. And having said that, using our ETFs, just bypass all these loops. And so that means this is misconception.
Yeah, I will agree with what Adrian mentioned, that there is a lot of red tape and a lot of processes involved for investors to assess the China bond market. Although they are opening up, there is also that mechanism in which you need to assess the market. And generally ETFs are a great way, a very convenient and easy way for investors to gain access to that.
I will stay with Adrian, and I will have a follow-up question for you because I think at this moment we have spent quite a bit of time talking about Chinese government bonds. And for investors who are still sitting on the fence and still wondering whether they want to get into Chinese government bonds or not, Adrian, my question to you will be, do you think investors should have an allocation to Chinese government bonds? If yes, what are the reasons?
So 3 simple reasons. High yield, good, strong credit rating, and diversification right now. On average, a 10-year Chinese government bonds are offering a high yield of about 3.2%. So that is the highest kind of coupon returns or yield versus developed markets government bonds. So that's actually very attractive. Second, like I did mention earlier, strong credit investment quality kind of investment into fixed income. And having said, Chinese government bonds are rated as A+. Now that is actually it's the same rating as Japan as well. And having said that, Chinese government bonds are guaranteed by the Chinese government. So looking at trade surplus, financially, Chinese governments are doing pretty okay versus the rest of the government. So, and they backed it up. They guaranteed the bonds that they issue. So that's another safety net. And third, diversification, right? The performance, in terms of performance and the characteristics of fixed income, Chinese government bonds characteristics, having very low co-relationship with the developed markets fixed income as well. So that present diversification benefits to investors. Yes.
I think Adrian has done an exceptionally good job in highlighting some of the investment merits of an investment in Chinese government bonds. Sounds good, but is it too good to be true? I think at this point, I'd like to also just highlight, perhaps to steer the conversation into talking about some of the potential investor concerns as well as risk areas related to Chinese government bonds. And that is when I bring Kelvin into this conversation. So Kelvin, I think Adrian just mentioned Chinese government bonds, they are rated A+ by the S&P. But at the same time, if an investor were to do a simple Google search on Chinese bonds, there is a very high likelihood they will find negative news headlines associated with a string of high-profile defaults. An increasing number of them are state-owned enterprises. So could you help our viewers to reconcile these 2 conflicting pieces of information and also perhaps some quick comments on the credit risk of Chinese government bonds?
Right. I think that was a very broad question, but I think the key point here for investors to understand is that not all bond segments or not all bonds are the same, right? China bonds fall into many different categories. If you remember earlier on when I was talking about globally diversified portfolio, I talked about a risk spectrum. I think investors that's really very important to understand. Government bonds are typically the safest segment of a bond market in any country, right? Because they are essentially explicitly backed by and guaranteed by the government. Now, there can be bonds that are more risky as you kind of take on more credit risk, and this segment of the market includes state-owned enterprises. Remember, state-owned enterprises are not the government. They're essentially different entities, so they do face a little bit more credit risk. And if you have read the news, you would have understood that in the Chinese economy today, the regulators are trying to tighten loan growth, right? Trying to tighten credit availability. And that tightening is done in a controlled manner, but nonetheless is resulting in some stresses in the credit markets and causing some defaults. So these defaults that are happening does not mean that the sovereign rating or sovereign status or health of the Chinese economy overall is under threat in a major way.
So based on what I'm hearing from the two of you, it seems that investors can safely assume that Chinese government bonds are a safe haven within a fixed income portfolio. But at the same time, for investors who want to invest in this particular segment, currency is a real risk because Chinese government bonds, they are denominated in RMB. And for most of us, Singaporeans, our base currency is actually the Sing dollar. So investing in Chinese government bonds actually introduces significant currency risk in our portfolios. So at this point, I want to ask Kelvin again, in terms of the RMB outlook, the long-term RMB outlook, do you have any comments that you would like to share with our viewers?
Sure. As a house view, we are positive on the renminbi from a mid to long-term perspective. We expect it to appreciate. I think right now it's trading at about 6.5 to the dollar. I think longer term you can potentially see 6.1 or even 6 renminbi to the dollar. I also just want to add in one point, given what Weiren mentioned earlier on, which is actually to define risk. I don't think the renminbi itself is risky, other than the fact that it is quite volatile. So the volatility can be quite high, and rightly so, given that it's an emerging market currency. But in terms of, it is definitely not risky in a sense that I absolutely do not believe that the renminbi regime will crash overnight. So investors should kind of maybe think about it from that perspective.
Yeah. I would just like to add on to Kelvin's point is that CSOP, our view is that renminbi has gathered a lot of pace last year, being the epicenter of the pandemic. They controlled it very well. There was a huge demand for renminbi. Appreciation in renminbi has actually appreciated a lot last year. And our view is that we still feel we are still having a good outlook for renminbi. But having said that, we felt that going forward, it will be actually more like a gradual kind of appreciation, a more like slow kind of appreciation going forward for the currency. Yes.
Okay. Thank you so much for the insights. If I had all the time in the world, I would really want to just ask them all the questions that I have related to fixed income. So I'd just like to round up today's discussion with one final question for our two panelists. So for investors who for investors who are considering an allocation to Chinese government bonds, how much of an exposure should they have inside their portfolios? So maybe I'll get Adrian to answer this question first.
Thank you. So it really depends on an investor's appetite, right? Do they want to look for higher return, or do they want to manage the portfolio's volatility? So it's really up to them. So we did a study by adding just a good 10 to 20% into an investor's portfolio, and we have a portfolio of maybe Singapore stocks, for example. Now it boosts up the returns a little bit based on the high coupons, and it also reduced the portfolio's volatility pretty much a lot. So it really depends, what the investor's appetite is. But we found that by adding 10-20% is a very good mix to equities, portfolio of equities, and our ETFs traded on stock exchange is about 10 shares per lot, so it's about $140 per trade. So many investors, retail or not, are able to use this ETF to just allocate 10 to 20% into their portfolio. Yes.
How about you, Kelvin? What do you think?
I think the ballpark 10 to 20% would sound quite right. The reason is because if you look at the size of the Chinese debt market, that's about 10 to 15 trillion dollars US. Globally, the total debt market would be about 100 trillion. 100 trillion. So that's roughly about 10 to 20% at the broadest level.
Thank you so much for your wonderful insights today. I think just to sum everything up, I think fixed income ETFs, they do have a place in all of our investment portfolios. I think our panelists today, they have mentioned a number of markets that you can consider for your fixed income portfolio, amongst them being the Sing dollar bond market, the US bond market, and we also had a very extensive discussion on the Chinese government bond market. And for investors who want to consider an investment in the Chinese bond market, a ballpark 10 to 20% is the recommendation from our experts to incorporate inside your fixed income portfolios. And with that, we have come to the end of our panel discussion on fixed income ETFs. And for those of you who want to get started with fixed income investing and you are not sure what ETFs to select for your portfolios, please feel free to check out our ETF focus list for a list of recommended fixed income ETFs. And with that, thank you for your time, and I will pass the time back to Geraldine.
Thank you, Weiren, and the various panelists. We will now proceed to the next presentation where we will have Weiren share with us about the benefits of being a frequent flyer. In this presentation, Weiren will touch on utilizing regular savings plans to help you invest long-term. Let us once again welcome Weiren.
Hi, good afternoon, everyone. It's me again. The main topic of my presentation today is on regular savings plan, RSP. And very specifically, I want to share with everyone some of the benefits of RSPs, of using RSPs inside your portfolio, as well as highlight some ETFs from our ETF focus list that you can potentially, that you can consider for your portfolios if you want to begin an investment in ETFs. Now, to start off, I'd like to first talk about some of the benefits that are associated with RSPs. And the very first obvious benefit of RSPs is that you can get started with investing with very limited capital. Because with as little as just $50 a month, RSP actually enable investors to get started on their investment journey. And this is especially true for young investors who may lack capital to start their investment journey. And starting earlier has its benefits as well, because it means you have more time for your investments to benefit from the effects of compounding returns. And as a bonus, RSP also tends to come with lower transaction costs, especially if you transact with FSM1. And this will translate into potential cost savings for the investors. Now, the second benefit associated with RSPs is that it provides you with a disciplined approach to investing. Now, when it comes to investing, probably we may have heard of this phrase, buying low and selling high. That's the key to generating profits from your investment portfolio. Now, to a certain extent, this is true. It is true that investors should buy low and sell high in order for them to generate profits. But the reality is that buying low and selling high, it's something that is very difficult to do, especially if you are an investor who lets your emotions control how you invest. RSP, this is where RSPs comes in to help investors to avoid this emotional investing, providing a disciplined way for them to get started in investing irrespective of market conditions. Because every month, what happens is a fixed amount of money will be deducted from your bank account to be invested in the ETF of your choice. There is no need for you to guess, and there is no need for you to be worried about missing out on potential investment opportunities. So it is a very disciplined approach to investing. Now, the third benefit associated with RSPs, and arguably the most important benefit, is that RSPs can help us to avoid market timing at the wrong times. Now, there will be a certain group of investors who come out and say that RSPs are actually not a good idea, because if you're able to time the market well, you can potentially deliver better returns compared to the investment strategy via an RSP. Now, to a certain extent, this is true, and this is true only if you are able to time the market well. Timing the market well is actually something that is very difficult to do. You may be able to time it well the first time, but to always time the market well on a consistent basis, this is something that is extremely challenging to execute, and not even investors like Warren Buffett can actually do market timing well on a consistent basis. So this is when RSP comes in again. And one thing to highlight is that RSPs, they can be especially useful in a bear market, especially when market conditions are extremely uncertain. And in a bear market, RSPs can actually help investors to mitigate their losses in downturns. And as you can see from the investment performance of a lump sum investment versus RSP in past market crises. If you're able to time it well, of course, your gains will be huge. But one misstep one wrong step that you take in the market could potentially lead to huge losses for your investment portfolio. And this is where RSP again comes in. It helps to mitigate your losses in downturns, and it also leads to shorter recovery periods compared to, let's say, a lump sum investment during periods of market crisis. Now, for investors who are not familiar with ETFs, or if you want to get started with an investment in ETFs via RSPs, now the first place that I would recommend you to go to is actually our ETF focus list, which basically condenses a list of over 3,000 ETFs listed on our platform into a list of over 50 ETFs for you to choose from. So it is a very good starting point for those of you who are perhaps not familiar with all the available ETFs, and you are just looking out for a low cost and a diversified way to gain exposure to all the different markets out there in the world. And you can also use this as a potential source of idea generation, or even use it to construct a portfolio of ETFs from scratch. And over the next few slides, I just want to highlight a number of ETFs that I think could potentially belong in your portfolio. And these ETFs could be a starting point for you to build a globally diversified portfolio. Now, the first ETF that I want to highlight is the Vanguard Total World Stock Index Fund. Now, if you just want one single ETF that can give you diversified exposure to all the key markets out there in the world, then look no further than the one by Vanguard, because this particular ETF tracks the performance of the FTSE Global All Cap Index, which also means that investors who are invested in this ETF, they will have exposure to a range of large cap companies, not just in developed markets, but in emerging markets as well, all in a single ETF. So it is a very straightforward way for investors to geographically diversify their portfolio. And if you already have an investment portfolio that is rather concentrated in Singapore-listed stocks, for example, then having this ETF in your portfolio will immediately give you diversified exposure to markets that are outside of Singapore. With over more than 9,000 stocks inside this portfolio, this ETF cannot be more diversified. And the bonus is that its expense ratio is only about 0.08%, which is extremely affordable and competitive in the world of ETFs. So in terms of the geographical breakdown of this ETF, this is the kind of exposure you are getting for your portfolios. About a 60% exposure to North American markets, 17% in Europe, and the rest of the exposure is divided amongst Asia-Pacific markets as well as emerging markets. So it is a very diversified portfolio that gives you exposure to all the key markets out there in the world. But at this point, I just wanted to highlight also that if you look at the geographical breakdown of this ETF, about 60% is in North America, which also means that this ETF has a geographical bias towards the US equity market. So if you invest in this particular ETF, just take note that this ETF has a geographical bias towards the North American markets. And if you want to make this a more balanced and a more diversified ETF across all the geographical markets, you could consider adding an additional Asia-focused ETF on top of this Vanguard World ETF. And this also brings me to my next point. If you are on the lookout for an additional ETF to complement your exposure to the Vanguard World ETF, then my recommendation is actually the iShares Core MSCI China ETF. Now, I specifically mentioned China in my presentation because China is the second largest economy in the world right now, constituting about 16% of global GDP. But the thing is that China's stock market, similar to the bond market, it is massively underrepresented in investors' portfolios. And in global equity benchmarks, for example, Chinese equities accounted for less than 5% of the MSCI World Index. So this is a mismatch in terms of the size of the economy relative to the representation of its stock market in the global equity benchmark. And China is also classified by many market participants and index providers to be an emerging market. And I think this classification is, to a certain extent, a bit misleading because China's economy is distinctly different from other emerging markets. China is not a beneficiary of global growth in today's world. Rather, China is one of the key drivers of global growth in our economy today, which is why China is distinctly different from other emerging markets. And from our point of view, China's equity market should be seen as a long-term allocation inside all of our portfolios and can potentially be used to complement a globally focused ETF like the Vanguard World ETF, as highlighted in my slides earlier. Now, if you look at the details of this iShares Core MSCI China ETF, is listed on the Hong Kong Exchange. The ticker code is 2801, and this tracks the performance of the MSCI China Index, which we currently think is the most representative of the Chinese equity market right now. It gives you convenient access to Chinese companies that are listed on multiple exchanges. So not just on the Hong Kong Exchange, but you're also getting exposure to Chinese companies that are listed in the US, as well as companies that are listed in the onshore domestic stock markets within China, all in a single ETF. It has about over 600 holdings with an expense ratio of 0.2%, so it is very affordable. But just wanted to highlight that perhaps one of the downsides of this particular ETF is that if you look at the top holdings of this 2801 ETF, you realize that there is a huge concentration of holdings within some of the big tech names, which includes Tencent and Alibaba. And this also means that the performance of 2801 is going to be tied to the performance of Chinese tech stocks in the future. Now, another ETF that I would like to highlight in my presentation today is also a digital economy ETF, or what is commonly known in the investing world as technology-focused ETFs. And I specifically want to highlight this because I think technology-focused ETFs, they tend to be seen by many investors as high-risk investments, very volatile, and are only suitable for investors who have a huge risk appetite. But I'd like to argue that technology has a role to play in all of our portfolios. Before COVID-19 came along, the adoption of digital technologies has already been underway. And now we have COVID-19, and the adoption of the process of digital technologies adoption has simply been accelerated. And in the consumer space, we're seeing increased adoption of e-commerce, increased consumption of digital entertainment, and even in the area of digital health and wellness solutions, we are also seeing greater consumer acceptance. Businesses as well, having an online presence is no longer a luxury, but a must for all businesses. If not, they run the risk of being eliminated from the industries altogether. And also to give you an idea of the size of the opportunity when we talk about the digital economy. The digital economy is worth about $9.5 trillion at this point. And if you see the digital economy as a standalone economy, it is currently the third largest economy in the world right now, just behind the US and China. And given its increasingly important role in the global economy at this moment, we tend to think that the digital economy has a place in all of our portfolios. And if you concur with our view, and if you are looking out for an ETF that can give you exposure to digital economy stocks, our recommendation for the digital economy exposure is actually the iShares Global Internet Giants ETF. Familiar to some of us who have always been following our seminars. So this OGIG ETF is actually a rules-based ETF, giving investors exposure to digital economy stocks that have quality and growth characteristics. Now, what do I mean by quality and growth? The definition of quality, in the words of the ETF issuer, it refers to the cash burn rate of the companies relative to their revenues. Growth characteristics will simply refer to the revenue growth rate of the company. And because of the way the ETF issuer incorporates these two factors into its overall index construction methodology, you'll realize also that OGIG actually gives you exposure not just to some of the big tech names within the technology space, but also to the small cap names as well. And you can see it from the top holdings of the OGIG ETF. Not only do you have exposure to some of the largest tech names in US and China, you also see names like Delivery Hero, Booking Holdings, and if you go further down the list, which is not highlighted in my slides over here, you will also realize that it also has exposure to companies like Zoom and Shopify, companies which typically don't appear in a generic technology-focused ETF. So we like OGIG because it gives us exposure, or rather a very broad-based exposure to not just big caps, but to small caps as well. In terms of its portfolio size, you're looking at about 90 stocks inside the portfolio with an expense ratio of about 0.45%, which of course, when compared to a generic S&P 500 ETF, it is not the cheapest option out there. But if you compare OGIG relative to some of the technology-focused ETFs that are available in the market right now, 0.45% is actually very competitive and very affordable. Now, one of the most commonly asked questions by our investors is, how does OGIG stack up against its peers? And when it comes to peers, the two most mentioned ETFs to us is number one, the ARK Innovation ETF, and number two, the Invesco QQQ ETF. Now, I think for the record, I just want to say that all these three ETFs are fantastic products to have inside your portfolio. If you want exposure to the digital economy or technology space, you can select any one of these three available options. But the reason why we feature OGIG within our ETF focus list is because, like I said, it gives us very broad-based exposure to not just the small caps, but also to the large caps as well. And this is distinctly different from the other two. QQQ, it is also relatively diversified, but you also realize that it has a geographical bias towards the US stock market. OGIG, on the other hand, it has quite a fair bit of exposure to tech names that are outside of the US. What about ARK Innovation ETF? ARK Innovation ETF has had a very good run in 2020. And if you are a believer of Katie Wood's stock picking abilities, by all means, please go ahead and pick ARK Innovation ETF as part of your digital economy exposure in your portfolios. But OGIG is better than ARK Innovation ETF because it is more diversified. Whereas for ARK, it tends to make very concentrated bets in certain companies, which if market conditions favor these small group of companies, it could potentially lead to outperformance of this ARK Innovation ETF as we have seen in 2020. But when market conditions turn against the companies within this portfolio, you will also realize that this ETF also tends to underperform other ETFs as well, as we have seen currently in 2021. Okay, but of course, having said that, I think all three are viable options. If you just need one recommendation from us, our recommendation is OGIG. Well, I will also want to talk about fixed income because we just came out of a fixed income panel discussion. I will not repeat some of the points on my slides because we have largely talked about it in our panel discussion just now. So just to reiterate, fixed income should not be neglected in our portfolios because it provides us with diversification benefits. It also helps to preserve capital. And on top of that, it provides fixed income investors with a regular stream of income. And if you are looking for your very first fixed income ETF to add to your portfolio, then my recommendation would be to first go to the Sing Dollar investment grade corporate bond space, as what Kelvin has mentioned in the panel discussion just now. And our recommended ETF for this particular space is actually the one by Nikko Asset Management. It is currently the first and the only ETF in Singapore right now to give investors easy access to Sing Dollar investment grade corporate bonds. And the key selling point about this ETF is that it is very accessible. With just as little as $50 a month, investors can gain access to Singapore's corporate bond space, which usually is not accessible to retail investors because of the large blocks required in order for investors to invest in individual corporate bonds. And just another chart to illustrate the diversification benefits of having bonds inside your portfolio, and you also realize that the performance of Sing Dollar corporate bonds is a lot less volatile than the performance of the Straits Times Index. So certainly provides diversification benefits to our portfolios. And lastly, Chinese government bonds is something that you can also consider for your portfolios. I think some of the investment merits has been highlighted by Adrian from CSOP in the panel discussion just now. Higher yields, not just higher yields, but and on top of that, China's credit rating is at a very strong A+ by the S&P, which is similar to the credit rating of Japan, higher than Italy, and just 2 notches below that of the UK and France sovereign ratings. And even if you take into consideration the impact of inflation, China's real yield is currently one of the highest in the developed world right now, whereas most of the other developed sovereign bond markets, they are offering negative real yields. So if you want to consider an investment into Chinese government bond space, then our recommendation is the ETF by CSOP, which is also listed on the Singapore Exchange. It comes with an expense ratio of 0.25% and currently has an average yield to maturity of about 3%. And with that, I just wanted to wrap up my presentation today by saying that RSPs are a disciplined, a fast-free way for us to stay invested in markets irrespective of the prevailing market conditions. And one of the key selling points of RSP is that you can invest with as little as $50 a month. And for investors who want to get started on their investing journey, I've highlighted 5 ETFs that you can potentially consider for a start. But if you want a more comprehensive list, please feel free to check out our ETF focus list. And with that, I've come to the end of my presentation, and now I'll hand the time back to Geraldine.
Thank you, Weiren. Coming up next, we have Robin Choi, CAIA Vice President, APAC Strategist, State Street Spider ETFs, State Street Global Advisors. He'll be sharing on going places with gold, enhancing portfolio performance with exposure to gold ETFs. Robin, please.
Good afternoon. Thanks for the kind introduction. So my name's Robin. As the MC said, I'm a gold strategist based in Hong Kong. So I recently read about the news in Singapore. So please keep safe, everyone, and hope the lockdown will be over soon in Singapore. So today, my presentation will focus on gold. So how to use gold as an asset class to improve your portfolio performance, especially with gold ETFs. For those who are not very, I guess, who hasn't invested in gold, some might think it's a jewelry product, it's a consumer product. But based on gold's historical history in the last 50 or 60 years, it has proven to be a very effective investment to enhance your overall portfolio performance. And today, for the next 20 minutes, I hope to share some of our view in terms of why investors should look into gold and how gold as an asset class will help your overall performance of your portfolio that you or your potentially your clients or yourself invest in. So today my presentation will be broken into 3 parts. Namely, the first session, I'll go through the case for gold in terms of why should investor hold gold as an investment. A lot of people see it as a jewelry, see it as a investment by, for example, central banks, for example. But as an individual investor or advising for investment, it's very important to understand the uniqueness of gold as an asset class. So I can share some of that with audience later on. And next part, I'll go through our latest key market themes that's affecting the gold market. So for those who are currently holding gold or hasn't really invested yet, we'd like to share our view in terms of what's the outlook for gold and what some of the factors, macro factors that we should be looking out for in the coming months that will impact the gold price trend. And lastly, I'll explain some of the ways to gain exposure to gold and look at some of the considerations and also the advantages of going through different products to get exposure to gold prices. So when you look at gold, I mean, as a Asian investor, every time I talk to an audience in Asia, I think people know what's gold, but a lot of people don't really dig down into the fundamentals of gold, because when you think about gold, it's actually quite unique in a way that it has a dual nature or a dual purpose in terms of gold is used by a jewelry demand, it's used by technology sector, but it's also an investment by investors, and central banks around the world do invest in gold as an investment. So if you look at the 4 sectors that drives gold demand and gold prices, you have clinical drivers, which means that during a economic positive cycle, you have more jewelry demand, you have more technology demand, which means that during a positive economic cycle, gold prices will go up because there's a lot of people buying more jewelry and technology. Obviously, that wasn't the case last year with the COVID situation and continue what's going on in present days. But last year, what drove gold price to record high was the investment and investment by central banks. So last year, investment through the counter-cyclical driver did drive gold price higher last year, and also demand into gold was at record high through investment last year. So when you hold gold through different cycles, you actually benefit from different times. So during an economic positive cycle, you have jewelry and technology that comes in. During an economic downturn like last year, we have investment that comes in to support gold prices. So not many asset classes do have this attribute. So if you look at oil or copper or silver, they don't have this, I guess, this uniqueness of gold's true nature. So if you were to ask me why gold, why should one invest in gold? I'll say there's 3 main reasons. So you can see on the right is that gold provides a very effective risk management tool. It provides a very, very decent capital appreciation. And also it provides your wealth. So it provides a very good hedge against, for example, inflation. And we'll look into more details in the next couple of slides. So at State Street, we deal with a lot of investors, institutional pensions, intermediaries. The number one key reason why big investor invest in gold, because what they see as a very, very low correlations to many other asset classes. So number one factor for gold, why investors like it, because it provides a very effective risk management tool to hedge against your other asset classes. So if you look at the graph here, it looks at the 30-year correlation of gold with different equities, Japanese equities, US equities, and also bonds as well. So when we look at correlations, anything that's very close to 0, that's a very, very good correlation, which means that gold does not move in line with other asset classes. So, for example, what we saw this week when the equity market corrected in the US, gold actually went up this week by about 3% because of these low correlations to equities and also bonds, you can see from these graphs. So it's very important when you invest in gold, you understand gold function. It's you can kind of treat it like a insurance for your portfolio, which means that if something happens to the market, gold has proven to be an effective hedge against what you're holding in your other asset classes. And one great example I can show you is that looking at gold's return through different, what we call the black swan events, where equity market has gone down more than 15%. Now, I use the US equity as a proxy because US equity is the largest equity market in the world. So we can actually see how gold can be an effective hedge against equities or global equities. So what I've done here is that I plotted the last 30 years when US equities was down by 15%, sorry. So you can see from the left, we have the GFC, with the COVID situation, Black Monday, for example. And every time, or not every time, but most of the time that you see here is that gold will return a very positive return. So for example, during the GFC, when equity market was down 47%, gold was up by 12%. And more recently, as I mentioned, this week, equity market was down about 1% in the US. I understand Singapore was down 3% because of the COVID lockdown. But gold this week actually outperformed most of the traditional asset classes like equity and bonds because a lot of money went into gold as a safe haven investment. So this demonstrates that when there's market volatility, when you expect there's an equity correction, then we advise investors to hold a allocation into gold, because what we have done here is that in most cases, gold has proven to be a very effective hedge against equity downturns. So we looked for or discussed about the risk management tool of gold. But one thing that surprised a lot of investors is that gold actually has a very decent return. So when you think about gold, people ask me why I should invest in gold because it doesn't provide a yield, which is true. But then again, gold doesn't provide a yield because there's no credit risk. So there's no risk involved or limited risk in holding gold. So that's why there's no interest to be earned. But if you look at the capital appreciation of gold in this chart, so you can see it in kind of the shaded dark green color, you can see that, especially if you look at the 20-year average return over the 20 years, gold actually registered about 9.9% capital appreciation every year. So on a 20-year basis comparison, it actually outperforms all other traditional asset classes like bonds, equity, commodities. And obviously the 10-year, it underperformed the global equities, but it still outperformed cash and also commodities. So it comes back to my point that gold, because it's driven by so many, I guess, different economic cycles, it's very important to hold gold over a longer term, like 10 years, 20 years, or even 30 years. So during different economic cycle, you have the jewelry, technology, central banks, and investment to drive gold prices, and also to drive gold demand throughout this longer periods. Another key point that why institutional investors like gold is because the trading volume of gold, it's quite significant. If you look at the chart on the right, for example, gold is actually the 6th most traded asset classes in the world. And when you think, why is that important? Because liquidity for an investor is important. Liquidity is very important when you want to get in and get out of the asset classes. And it's particularly important when there's a market downturn, because when there's a market downturn, everyone wants to sell their assets. And when there's not enough liquidity, then your asset will be expected to take a hit. So during the GFC or even last year, a lot of illiquid assets got a major hit because investors couldn't sell when they needed to. And why is it important for gold? Because when you invest in gold, you want to use gold as the insurance for your asset classes. So if you need to sell your gold to, for example, cover your marginal losses for other asset classes, you can easily sell gold because it's so highly traded on a daily basis. Gold trade about 180 billion US a day, and you might wonder, because Bitcoin is so happening right now. What's Bitcoin trading volume? Bitcoin trading volume right now is about 3 billion US. So if you compare gold and Bitcoin, gold actually trades about 90 times more than Bitcoin. So a lot of questions do come to us to go, can Bitcoin become the new gold? Based on this factor, you can't, because liquidity is not comparable when you hold gold as an asset class. So it's very important that investors understand that liquidity, it's a key attribute of gold when you invest in this asset classes because it's traded on a very, very high substantial level. And also the wealth preservation of gold is that it provides a hedge against one, inflation, and two, currency depreciations. So on the left-hand side, you can see gold performance during various inflation scenarios. So if you look at inflation when it's higher than 5%, gold average return is 16.2%. So we're looking at US inflation because US inflation actually dominates or has the most impact on the dollar and also gold prices. So we're looking at the US inflation here specifically. But as we gather more information about inflation right now, we know the US is having some pressure in terms of inflation. The CPI data came out this week that it was up 4.2% year on year. So inflation, it's a key risk for investors. So we are now advising a lot of investors that you should hold some gold because inflation are coming back. So it's very important with all these policies that the government, central banks are pushing out. Inflation, it's going to be increasing in the future. So if you look at gold's historical function as a hedge against rising inflation, it provides a very, very good hedge based on the average return for each scenario. And on the right-hand side, if you look at what I'm trying to show you here is that I'm trying to show the fiat currency versus gold in terms of the depreciations. You can see that if you look at all other major currencies, the US, Euro, Japanese yen, and pound, it has all depreciated against gold. So if you look at gold at 100 level, throughout the last 100 years, fiat currency has actually depreciated a lot against gold. So a lot of investors that invest in gold, they invest in gold because they are worried about the fiat currency, the money pumping, the potential supply of money that will have impact on the fiat currency valuations. Because gold cannot be printed, it needs to be mined every year. This concept sits very well with investor, which might, they have a very large holding in fiat currency. So that's where one factor that is very important to understand, that gold can provide a very, very effective hedge against currency depreciations. So if we put everything together, so we discuss about the risk management, the capital appreciations, the wealth preservation. So what does that mean for an investor? So as I said earlier, when you invest in gold, you need to invest in gold as a strategic asset classes. So don't look at gold as a single asset class that you expect to go up 10% every day, for example. You should look at it overall in terms of your portfolio, what you're investing other than gold. So here we've done a lot of analysis surrounding where you put 10% allocation into gold into different types of portfolios, ranging from conservative, which means that there's 20% into stocks, 80% into global bonds. Aggressive means you have 80% into stocks, 85% into stocks and 50% into bonds. So what you can see here is that as you increases your exposure to equities, and when you invest 10% in gold, it actually reduces your portfolio drawdowns throughout the last 30 years. So for example, we look at aggressive. If you had invested 10% of gold in that portfolio, you would have reduced your overall loss during the last 30 years by 5%. And that 5% is huge because that's 5% of your overall portfolio. So gold, by having 10% of that allocation, plays a very powerful function in your portfolio by reducing the maximum loss and also what we call increasing the risk-adjusted return of your overall portfolio. Another question we always get is, okay, I understand the concept. What's the allocation that we should advise to invest in for investors. Our advice is that we always encourage a strategic allocation, which means that you hold gold for a long term. And the allocation can sit within 2 to 10% of gold into your portfolio. So which means that if your portfolio is worth $100, then have about $2 to $10 of gold in your portfolio, because this graph might look complicated, but we've done a lot of back testing surrounding that. Depending on what portfolio you hold, the optimal allocation is between 2 to 10%, because this chart looks at the change in the risk-adjusted return. So if you look at the graph here, when it flattens out, that means that's the max ratio you should have. So if you look at the aggressive portfolio, it flattens out at about 10%. So if you have, for example, 85% into equities, 10% into bonds, then you should have 10% of allocation. So there's no right or wrong answer. It's just a benchmark for you to consider. We have investors that invest over 10%, and that's reasonably fine. But when we say, or when they invest over 10%, we call that tactical. So you might have a 10% strategic, and over the 10%, you can have that tactical allocation that you can change on a daily basis. But on a strategic basis, we always encourage to have 2 to 10% of your overall. Then you can rebalance it on a quarterly basis or on a yearly basis as well. So to conclude what I was trying to say in the last couple of slides, so gold is a very, very powerful strategic asset because, one, it provides diversification that we went through, low correlations. 2, returns, as we saw over a 20-year basis, about 9% return on a yearly basis. Huge amount of liquidity, which is important given potentially there's a market correction. We saw some correction this week and in May, so that's something to look out for, needing something to have highly liquid to trade. And also lastly, we went through a very, very simple exercise of that gold can have a huge positive portfolio impact to your portfolio. So this is the 4 core reasons we talk to institutional intermediaries and also investors we talk to. This is the core stepping stone why you should invest in gold. So I hope I convinced some of you to look into gold at the meantime. So in the next couple of slides, I just want to go through the outlook for gold, because for investor, obviously, it's very important to understand how gold will trend in the next couple of months, and also for those tactical investor that want to trade in, trade out on a daily basis. Obviously, this graph looks at gold price since last year, and gold price did reach record high last year because of the COVID situations. But then since September, it has been trending down because of the global vaccinations, globally, a drop in cases between September and January, and also investors becoming more risk on because economic growth was improving notably in the US and also Asia. But in March, what we saw is that gold was able to, I guess, form a very strong supporting level at 1,700. So we're quite comfortable that gold price has set a very, very strong level at this level, because during March, it was unable to break below that level. So I'm very confident to say that gold will be very difficult to, I guess, go below that level unless US dollar or the Fed increase interest rate, but that's not going to happen. So what we're seeing right now is gold price is about 1830. So it's actually gaining a lot of momentum right now. So if we look at all the technicals, it's trading above its 50 and 100 days moving averages. So if you ask me now, the technicals are definitely a lot better than a month ago. So just watch out, because I think particularly next week, I think a lot of data or continued correction in the stock market will continue to support gold prices because investors need gold as a hedge against market uncertainty. But over the longer term, why I encourage investors to hold gold at least for the next 3 or 4 years, because we know that the rates, it's going to be very, very low in the US. In the US, we already know that the Fed won't increase interest rate until 2024. So low interest rate, zero interest rate will always benefit gold price because it lowers what we call the opportunity cost of holding gold because there's no yield elsewhere. But what we're seeing right now is that inflation, it's rising very quickly. So if you look at the chart on the left, we are looking at the 10-year US Treasury yield and also the 10-year inflation expectation. And throughout the last couple of months, the inflation expectation in the US has been rising really quickly because of the continued monetary policy adopted by the US and also the fiat fiscal policies that adopted by the Biden camp. So they're pushing out trillions of fiscal policies. So inflation expectation has been on the rise, and that's true because we saw inflation figures this week in the US was one of the strongest we've seen in recent years. But what this means is that when inflation goes up faster than the Treasury yield, the real yields actually stays down or stays negative. The number one fundamental driver, if you look at gold price for the last 30 years, 40 years, is the real interest rate, which means it's the nominal yields minus the inflation expectations. So if you look at the graph on the right, you can see that the real interest rate in the US, it's negative. It's around -1, which is close to its historical low. So low real interest rate will continue to benefit gold prices. And at State Street, we continue to see low real interest rates in the next, at least into end of this year or next year. And negative yield rates support gold price and also support investors rotate out of bonds and cash into gold. And we have many investors that we talk to that they're rotating out of bonds because they don't want to hold negative yield bonds and they rotate into gold. So that's why we're actually quite confident fundamentally because of this reason, gold demand will remain quite strong through the investment space, and that will continue to support gold prices in the near future. Another key factor we think will have a very positive impact on gold is that we know that the debt levels are rising everywhere. So if you look at all the major central banks balance sheets on the left-hand side, so Bank of England, Japan, Europe, and also the Fed, you can see the debt level has been rising. And that's something might not be concerning for now, but fundamentally it should be, because if you look at the debt levels since COVID, the unlimited printing by government to support the economy and also to support, for example, the stock market, this will be I guess, a tailwind for gold over the long term. So the rising debt level and also liquidity will be very beneficial for gold. And also on the right-hand side, you see a US budget deficit against the gold price. So what you can see is that on the blue line, the US budget deficit as a percentage of GDP, it's close to about -18%, which means that the US or the Fed, or not the US, the Biden government has been pushing many fiscal policies to the point that the budget deficit, it's at historical high in negative terms. And this is actually very concerning for some of the investors that look into this data because the increasing budget deficit will put a lot of pressure on the US dollar. which in turn will benefit gold because the US dollar and gold price has a very strong inverse correlation historically. And that's why you can see on the right-hand side of this chart, the declining of budget deficit has been very beneficial to gold in the last 30 or 40 years. So that's some of the factors and indicators we're looking very closely and try to, I guess, voice this concern to investors, because this trend will definitely impact the dollar in terms of the trend, whether it will go upward or downwards in the future. So the last two slides will come back to the point that the US dollar will continue to be weakened because rising inflations, rising debt level, rising central banks' debts will put a lot of pressure on the dollar. And as I mentioned before, if you look at the left-hand side, the graph, it looks at gold's correlation dollar throughout the last 40 years. And you can see the correlation fluctuates throughout the last 30 years. But at the current junction, the negative correlations, it's about at 0.4 negative. So which means that when the dollar goes up, the gold will go down, but dollar goes down, the gold price will go up. So at this current junction, it's close to its long-term average correlation. So at State Street, we believe the dollar will continue to weaken. And I think we are quite confident it will because of the low interest rate, of the inflation factor, budget deficit. And when you think about US dollar weakness, some of the question we get, okay, I believe the dollar will weaken, so what should I buy to hedge it? So what I've done on the right-hand side is that we looked at every single US dollar bear market and bull market, just for your reference, comparing asset classes like gold, commodities, S&P 500. So if you look at US bear market, historically, what tends to do well the most is gold. So on average, when the US dollar is down by 28%, on the left-hand side, gold on average accumulated return will be 142. So this is a very, very powerful message to show that if the dollar continues to weaken, gold will benefit the most. And a lot of investors right now are holding gold because of this factor, because they expect the dollar will continue to weaken. And for us sitting in Asia, Hong Kong and Singapore, it's very relevant because where I'm based in Singapore, my currency is hedged or pegged to the USD. So I have to make sure I invest in some gold to hedge against my Hong Kong dollar depreciation, for example. So for local investors like us, if you expect the dollar to be weakened, then you might look into gold, for example, in Singapore dollar currency term to hedge against the potential weakness in the dollar. So the last slide, I just want to wrap up. So hopefully I was able to convince some of you to look into gold because I truly believe right now is a very, I guess, attractive point to look at it because gold this month, it's already up 4%, purely because of investors going more risk off. And we believe the next, I guess, testing level will be 1850 next week. And if that happens, we'll be retesting 1900 again. So that's something to look out for some of the investors right here. But to get exposure in the gold, there's so many ways. So on this table, you can see there's 6 ways to literally get exposure to the gold prices. So you have paper gold, bars and coins, mining stocks, gold futures, mutual funds, and gold-backed ETFs. But from our perspective, we do encourage investors to look at gold-backed ETFs. So ETFs that traded on, for example, the Hong Kong Exchange or the SGX, because gold-backed ETF is one of the most transparent and cost-effective way to invest in gold. So gold back ETF trades like a stock. So you can see the price, you can see the trading volume. But what more importantly is that gold back ETF is fully backed by physical gold, which means that each share of your ETF has gold backing the shares, and the gold will be held in a very secure vault, maybe in Singapore, in London, or in New York, for example. And one of the benefits of gold back ETF is that you don't have to worry about the transportation and storage costs. And why I say that, because for those investors that invest in physical, one of the main consideration is that you need to store the gold, and you need to put the gold somewhere safe. So for investors that might have very substantial amount of gold, this is one of the most factors they need to consider where to put the gold. But with gold-backed ETFs, paying a very, very relatively cheap price, that will cover the consideration of all other vehicles that I mentioned here. And lastly, I think gold-backed ETF, because it's one-to-one correlations to gold prices, so you get this perfect tracking to the spot price of gold if you want to invest in gold as a strategic allocation or either tactical allocation as well. So I believe my time is up. Thanks for the time today. I hope everyone did find out more about gold investing and how you use gold as a hedge against the equity market. And I hope you enjoy my presentation. Thank you very much.
Thank you, Robin. It is now time for our second quiz of the day. 3 participants with the most accurate and fastest answers will win 3 units of the ETFMG Travel Tech ETF. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the black menu below the video window. And under the section Agenda, click on Quiz number 2. And then click on the Join Quiz button. The activity window will be displayed on your right. Once the quiz ends, a leaderboard will be displayed and you may check if you're one of the winners. On the Event Live page, look to the right side where it says Quiz, click on it, and we will start with a trial question. I hope you're all able to access the quiz. We'll start in a few seconds. Starting with a warm-up question, what was FSM1.com previously known as? If you know our email address, you will know what the answer is. The answer is Fun Supermart. Good job to 74% of you. Now that we're all warmed up, let's get ready for question number 1. Which of the following statements about fixed income's role in a portfolio are false? The answer is option 4. Keep in mind we're looking for the most accurate and fastest answers, so even though you have to be fast, do read your options very carefully. Question number 2. Which of the following is a benefit of a regular savings plan? And the answer is option 4. The majority of us got it right. Good job. Question number 3. Which of the following ETFs is included under the commodity sector in the 2021 ETF focus list? Fastest fingers first. The answer is option 1. 50% of us got it right, 50% of us got it wrong. It's okay because there are 2 more questions to go. Question number 4. Which of the following are not fixed income sectors? And the answer is option 3, real estate investment trusts. The final question is coming up. Let's all get ready. Question 5. In the benefits of being a frequent flyer session, which of the following ETFs is not included in the RSP portfolio? Choose very carefully. And the answer is option 4. If you missed out on this one, it's okay because we have one more quiz coming up. If your results screen shows rank 1, 2, or 3, you must take a screenshot showing the whole activity window right now and make sure that your rank, score, and nickname are captured clearly. Then email the screenshot and also include your name, FSM account number, and the daily quiz date to events@fundsupermart.com by 21st May to claim your prize.